Hey YouTube, this is Zach with Achilles Financial, and today I want to talk about CDs. And one of the reasons why I'm bringing this up is because last week I talked a little bit about risk-free rate of return and treasury yields. And today I want to highlight that right now, again, we're seeing very, very attractive rates on certificates of deposits. These are generally held at banks, whether that's smaller community banks or larger institutions. But this is essentially where you can park your money and you will receive this percentage rate on an annualized basis. So if you buy the 9-month CD here at the 5.25%, you will not receive 5.25% on your hypothetical $1,000 that you would put into the CD, but rather you would receive an annualized rate of 5.25. So for the 9 months of the year that you hold that, you would receive the equivalent of that percentage. Now, the 1 year right here, you would receive that 5.52. The reason that I hold this or am showcasing this right now is because as these start to tick up, you're going to continue to see investors rotate out of risk-on assets into risk-free or much more limited risk assets like we're seeing here on the screen. Right now, a institutional investor, so this is someone with a lot more money than yours truly, is going to be watching generally the 3 to 5 year CD rates. Now, the reason for that is because generally speaking, if you are a larger scale investor, you are going to be looking for a place to park large sums of money without having to move it. When I go out and I buy stocks, I am not going to move the stock buying $1,000, $5,000, $10,000 at a time. And that is because most stocks that I am currently purchasing and or selling are relatively liquid, and a couple $1,000s is a drop in the bucket over the overall trading for that stock over the course of the day. That is not the case for much larger investors, especially if you think of someone who is trading with millions or large funds that are in the billions of dollars. So when we're looking at a 5.57 rate for 2 years, if you're talking $1 million, you're talking more than $50,000 a year that you're locking down for the next 2 years. Now that is taxed at regular income, so you would have to take that into consideration, but that is a very attractive yield, especially compared to the volatility in the stock market. Now, what I want to highlight is when we're reviewing these, you're going to see some noticeable differences between if I transition over to one of the screeners that I like to utilize here. And you'll notice in this screener that I've got available here, I have this showcasing a number of items that I like to check on a routine basis. One of which is going to be the dividend yield. The reason that I have this capped at 8% is because generally speaking, if this is over 8%, it is because of something that should not be that way. Generally speaking, it's a special dividend or some other odd item there in that breakout. The other thing that I'm looking at is, are they a large cap company? Are they something that's a bit more established? And then, are they profitable? So these are items that I track on a routine basis for potential investments. Now, what you'll notice here is on these dividend yields, in this list of companies, there are 22 of them, that about halfway through the list, you start to see that that rate I was showcasing on the 2-year begins to beat some of these. Now, I'm not going company by company, and there are definitely some of these that I would have no desire to invest in, but you're going to see that despite the fact these are highly profitable companies, most of them are larger companies, each individual tick up in interest rates and accompanying CD rates are going to mean that that theoretical risk-free rate of return is going to be quite a bit safer than the dividend yield that I may be targeting here. Conversely, if we go back to those CDs, so if I hop back into the platform, and if you're wondering what I'm using on the screen right now, this is the TD Ameritrade website. But as you can see, when I'm looking at some of the investments right here, especially if I go out to the 5-year plus range, if we go up another 25 basis points, or let's say another 50 basis points, then that's 6% on this theoretical investment. And again, I recognize that a interest rate hike does not directly correlate to an adjustment here, but I would highlight that if we go up another 50 basis points, or to 6% for 5 years, that means that I am going to be higher than the average cap rate for a lot of multifamily and 1 to 4 family properties. The average rate of return for those investments can be anywhere from 4 to 10% on average. But if we're at 6%, that means that for every subsequent tick up after that, we're going to be edging out more and more investors who want to take advantage of the recent rise in multifamily as well as 1 to 4 family properties, when if they don't need the tax benefits, they can move that money over into a much safer investment and lock down those returns for 5 years. Again, with each multiple, $1 million means $60K a year. $10 million means that you are getting $600,000 a year to not do anything. That is a very, very attractive sum of money. So this is some of the information that I am tracking in terms of picking out investments, and one of the reasons I remain overall bearish on the overall stock market, because at a certain point in time, as this money as this CD rate continues to go up at different banks, you're going to continue to see people be incentivized to move their money from more risky investments into safer investments, especially as they continue to be more attractive. So this is what I'm watching. This is what I'm evaluating. Feel free to let me know in the comments down below what you're tracking and any alpha you may have to share. So if you made it this far, thanks for watching. Talk to you soon.